but I'm glad this is perfect analysis. That raises a question mark on the monetary policy of central banks, whether the policies are effective. Because a good monetary policy, okay, is supposed to have the appropriate effects in what we call the transmission channels. So when it comes to monetary policy, there are two main tools of monetary policy. One, you have the quantity of broad money that is supplied into the system. Number two, we have the monetary policy rate, and then in some countries, they now have a system called the reference rate system. Okay, so the monetary policy and the reference rate system basically works like this. The central bank will determine the base value of interest rates, and then it gives that to the banks, the other commercial banks. The commercial banks are supposed to pick the base rate. So let's say the central bank says that, okay, for this year the monetary policy rate is, let's say, 10%. It communicates that to the banks. The banks will now pick that, and then the Banking Act tells them to also factor in their risks. So they also quantify their risk in percentage terms and add it to the 10.5. So by the time they are done, the final rate they will charge on their loans is much higher. Okay, so in the end, that's what we are talking about. In the end, the unfavorable nature of the monetary policy regime is that it leads to increases in interest or lending rates. As a result of that, private investors are unable to access loans. Even if they access it, it is difficult for them to pay because of some of the structural problems you were highlighting. Some of them may default. If they default and they file for bankruptcy, a lot of people lose their jobs. But even if they struggle to pay it, it is still difficult for many of these firms. So it turns out that in many places in Africa, government still remains the biggest borrower. That is called the crowding out of the private sector. So it looks like government is a huge guy, but he's able to access all the loans and spends it on frivolous things. We don't want to go into fiscal policy. And then the private sector, which is supposed to be the engine of economic growth, is sort of pushed out of the market because the interest rates are high. That is a real problem, and anytime interest rates are high, it means that the monetary policy of the central bank is ineffective. That's the case in Ghana.
And most African countries.
Okay, so that's it. So monetary policy is a problem, but if I want to be a bit mild towards the central bank, they will have to analyze monetary policy in relation to fiscal policy. Fiscal policy has to do with government spending and then the taxation regime. So we have to look at monetary policy versus fiscal policy. It turns out that in most cases in Africa, there is what is called fiscal dominance, in the sense that government expenditures and then taxes renders the monetary policy regime of the central bank ineffective, because government spends so much to the extent that even if the central bank increases the supply of money, the stimulus effect is neutral or negative. So fiscal dominance is a problem in Africa because government overspends. Another problem is that we have to look at the transmission channels for fiscal policy. What does government spend on? If you have a situation where government does not spend on the most productive sectors of the economy, like agriculture, when in most African countries agriculture is the backbone of the economy, and you have government spending in other sectors, non-productive sectors, you have a problem, because it means that government expenditure, that's fiscal policy, will not have the appropriate effect in the economy. So fiscal policy and monetary policy are very serious, and what you highlighted is just a clear case in point when you are dealing with countries whose central banks use what is called the inflation targeting regime. And I don't want to criticize the Bank of Ghana, but you see, another transmission channel for monetary policy, okay, is exchange rates and inflation rates. It turns out that the Bank of Ghana, I don't know about Nigeria, but I'm sure it will be similar. We are similar and alike in Africa. So yeah, we are, because the central bank's inflation targeting regime says that the Bank of Ghana must maintain inflation between 8 plus or minus 2%. That means if inflation goes high, maximum should be 10% or 6%. The evidence or the data for several years shows that that's not the case. The Bank of Ghana is never able to meet this target. Does interest rate reduce? No. Interest rate is increasing, inflation rates are increasing, exchange rates are increasing. These three show that the monetary policy of the Bank of Ghana is ineffective in driving economic growth.